City of Stevens Point Finance Committee meeting, recorded October 26, 2020.
It is 6 o'clock. I will call the meeting of the Finance Committee for the City of Stevens Point to order. It actually was 6:01, so that's what should be noted on the minutes. And the first course of action for a meeting is a roll call. And I don't know, are you doing that, Corey? I don't know if Carrie is on.
Yep, well, I know she's on too, but I've got it ready to go here.
Okay.
Dalton.
Here, but not here. Can you hear me?
Yeah, we can hear you.
Oh, okay.
Johnson.
I am here.
Morrow.
Here.
Shore.
Here.
Slowinski. And I know that Alder Slowinski was having difficulties connecting, so maybe he'll join us later. Right now I have 4 present.
All right, thank you. We do have a quorum. Excuse me. And so our second item is obviously a review of the 2021 operating budget and adjustments to the 2021 capital budget. The third item, of course, is setting the levy, and had a brief email conversation with Corey today. Again, the budget is a large document, and in Corey's presentation that arrived last evening, even though it's very thorough, and if no one has any objections, I would ask if we could forego the item 3 recommendation of the 2021 property tax levy to Common Council to our November Finance Committee meeting. So that will give Finance Committee time to evaluate, and members of the council time to evaluate, again, the very well done PowerPoint, do a little bit more deep dive into the budget. And I'm seeing a okay from Alder Shore. Is there any objections? Alder Morrow?
Okay.
Okay. Alder Dalton?
Okay.
All right. Wonderful. Then we will just have, and I didn't know if Alder Slowinski was on yet. He is not. So we had 4 okays.
He is on.
I am here. I don't know if you can hear me.
Oh, thank you. Thank you. I'm sorry. I didn't see. Did you hear what
And
I had
I'm still
asked?
having issues. I just got in, but I cannot get in. I cannot launch the Stevens Point website to get to the agenda. So
Okay.
I don't know what's going on. I still can't get in there.
All right. Well, what I was suggesting, Alder Slowinski, was because, the budget's a very massive document. The presentation, which Corey sent to us, just arrived yesterday. In order to give the Finance Committee and the other members of council time to consider the budget and the proposed levy, that we wait for action. So item 3, we would put off until our November Finance Committee meeting. Do you have any objections to that?
Nope. Thank you for doing that.
You are very welcome. All right, Corey, I'm going to turn this over to you.
Okay, thanks. Well, we'll dive right into it here. I'll put up the PowerPoint. Okay, so everyone should hopefully be able to see the PowerPoint on your screen. First of all, just start off with some budget highlights. So as usual, we budgeted for continuity of services. The first task really with every budget is to figure out a way to make sure that we have enough money to fund all of our current services, all of our current positions. Sometimes that can be a little bit more challenging in some years than in other years. And this year that was a little bit more difficult just due to the fact that we do have a lower net new construction percentage than we've had in the past. So that restricts our ability to increase the amount of property taxes that we collect for the operations of the city. We also had some COVID-19 related revenue impacts, which I'll get into in some further slides. So overall, in order to have the continuation of existing programs, still be able to provide cost of living adjustments and everything like that to our employees, we did have to sharpen the pencil a little bit. We are looking at a reduction in health insurance premiums, and I know that we already had started talking about that actually a few months ago, I believe, on that being a potential budget solution. And then we did make some adjustments for City Hall courthouse expenses, and also reduce the transfer to the liability property reserve fund. And I'll get into more of what those are as the presentation goes on. As far as increases for the line item, in better years, we're able to give each department an allocation for increases to their discretionary line items so that the buying power of those items is maintained. Unfortunately, we were not able to do that this year just because of it being a tougher budget year. So any increase that a department needed had to be offset by a decrease in another line item. But we were still able to increase the overtime budgets based on the relevant changes to wage rates. So for instance, the overall cost of living adjustment for the city was 1.56. So we were able to increase the overtime accounts by that amount. For police and fire, we did the increase to match their the increases that they bargained for 2021. So again, so that you are still able to provide the same service and get the same number of employee hours out of that overtime budget. So now going to the budget summary page, this is just a quick summary of a variety of items as far as the budget changes for different departments. One of the things that I want to note about this budget summary change, and it seems like it's something that can throw people off, just that sometimes you'll see decreases in a department, and typically those are due to the costs actually changing within that department. A big one is changes in health insurance enrollments. That can lead to lower costs for operating that department, which can make them show up as a department that had a budget reduction, when really it's just that their costs have gone down. And you'll also see that if a department has a high amount of turnover, you know, of course, having a pay plan where employees go through a series of steps, that employee leaves, they get replaced by someone else at a lower step. There's some savings there. So that's why you'll see things being a little bit more all over the board sometimes as far as which costs have gone up and which costs have gone down, just based on some of those changes that you see in those departments. And then another item that I'd like to note is general government is going to look a little bit high as far as an increase. Part of that is we moved some wellness expenses from the health insurance fund into the general fund and under general government. So that's part of what's pushing that increase up. And then also wanted to note for capital improvements, that is just the amount that is supported with the general fund. It does not include the amount supported with borrowing. So that's why you might look at that and say, well, wait a minute, you know, we approved a much larger capital budget, over $6 million. Why does it only say 1.2? And the reason why is because that's just the portion that is supported with the general fund dollars. And then finally, getting down to the bottom, we have some discussion on levy and the general city tax levy and the debt service levy. You'll notice that the general city tax levy increased by 1.64%. That's the increase in the levy for operations. However, our net new construction number was only 1.19. The rest of that increase is backfilling a reduction in our personal property aid payments. And then also the total city tax levy, you're seeing an increase of 1.44%. So that is the actual increase as far as the total amount of taxes that the city will collect. However, due to some of the issues that we've discussed at some previous meetings related to valuation and related to how our TIF districts got valued this year, we're actually looking at an increase in the tax rate of 2.1%. I know that sounds a little counterintuitive, that even though the total amount that we're collecting is only going up by 1.44, the actual increase in the tax rate will be higher than that. But that's just because of some of those valuation changes, when what you essentially have is a situation with less property tax base supporting that levy for 2021. And then that situation, it will reverse next year, so it's really just a one-time hit. But I just wanted to make sure that I explained that, just so that we don't have people who are expecting a 1.44% increase. So, and then these slides just cover what I just went over. So, so as far as the sources of available funds, we already talked a little bit about net new construction. That gave us an extra $143,000 this year, which isn't a lot. It's not as much as in previous years. Unfortunately, it's not enough to cover the increase in our costs due to inflation. So that's why we did need a few other solutions. We're expecting to save about $105,000 with the reduced health insurance rates. We're looking at a reduction of $69,000 for reduced election expenses, because next year, rather than having a presidential election, we'll only have 2 small local elections. So that certainly makes a big difference. We did have an increase actually in one of our state aid payments, and that's our Municipal Services payment. That's our payment for providing services to state-owned facilities. And I'll talk a little bit more about that in a future slide. We did have an increase in the payment in lieu of taxes that we get from the water utility, $50,000 there. We also reduced the budget for City Hall maintenance by $20,000, just based on how that line item has been performing and how those costs have been coming in. And then we also reduced the transfer to the Liability and Property Insurance Reserve Fund by $20,000. So looking at, go ahead.
Corey, I just have one question. If we could go back to the reduced health insurance rates.
Yeah.
And and at the county level, or at county board, I'm on HR, and we talked about health insurance rate. And there was a reduction because people are not going to the doctor as much, because they are not getting optional procedures, and they're staying away from the hospital and clinics because of COVID, unless they're seriously ill. In looking at that, I don't know who did that, how your team did that. Is that reduction as a result of what happened in 2020, or are we just trying to moderate that because we could see increases in 2021 if we get past COVID, which would be wonderful, and people start doing more elective procedures, they go to the urgent care, those types of things?
Mm-hmm. Sure. So definitely there was a reduction in health insurance claims due to that, especially in the early kind of months of COVID-19, March, April, and May, when you had that lockdown. And now what we've seen is that you do see that start to rebound as people have gotten out of lockdown mode a little bit and are starting to have some of those things done. But with the reduction in health insurance, the important thing is that actually is something that's been consistent from year to year. So, you know, we had good performance in 2019, we had good performance in 2018 and 2017, and we've been building up that fund. So one thing that we wouldn't do for sure is just to say, okay, well, you know, we have one good year, let's reduce health insurance rates, just because you have to look at it on a more multi-year basis, that you're going to have good years and bad years. But we've consistently had strong performance in the health insurance fund over a number of recent years. So we're not just basing it on this year.
Right. Thank you.
Yep. And I'm sorry, I'm just trying to also let people in, which is something that I'm not as used to doing. So, okay. So the net new construction, as you can see, the number of 1.19% is pretty low. In past years, we've really relied on one or two large construction projects really making it for us and really making a big difference. And, I'd always kind of worried that, well, boy, what happens in that year when you don't have the $15 or $20 million project to really make your net new construction number. And that's kind of what happened for 2021, or for the 2021 budget. So it actually would be construction that happened during 2019, where we had a number of small developments, but we just didn't have that big 10 or 15 or $20 million project to really push up that number. So overall, our total net new construction was $25,281,000. On the screen, you can see the various businesses that contributed to that. And then also, you'll notice for residential construction, that was about $7.2 million. So as usual, in recent years, the city has really gotten most of its growth in property tax base from commercial properties as opposed to residential properties. And part of that is just based on, the amount of land that we really have for residential construction or for new subdivisions. So it's been mostly commercial construction that's really been growing our tax base in recent years. So, and then covering the reduced health insurance rates. So it's a reduction of 7.6% overall as far as the total cost. We looked at the rate of our family plan versus the rate of our single plan, and we compared it to some other municipalities and some other entities, and we noticed that it seemed like the ratio between the cost of the single plan and the cost of the family plan was a little bit off, that family plan was priced a little bit high relative to the single plan. So that's why we're leaving the single plan rates the same and then reducing the family plan rates by 9.1%. And the resulting total savings there from that reduction is $194,000. However, we're also proposing another change with this, and that is right now the wellness expenses for the city are getting charged to the health insurance fund. And the rationalization there is that your wellness fund should reduce your health insurance claims, and you should have that return on investment within your health insurance fund. And I think that that's justifiable. The only downside of that, or the only thing that I think needs to be kept in mind, is that when you do it that way, your employees who are paying 10% of the premium now are also paying 10% of your wellness program. And if you have somebody who needs to go on COBRA coverage or a retiree, they're paying 100% of their premiums. So it's sort of a fairness thing to say, well, our health insurance program is not exclusively funded by the city itself. We do have our employees pay 10% of the premium. Our part-time employees, if they want to take the health insurance, they do have to pay a larger percentage. And then you do have some retirees and some people who, could always have to go on COBRA coverage. You never know. So this is just sort of restructuring that so that the wellness program would be paid by the city general fund. So basically, with lowering the health insurance premiums, we're really doing two things. We're lowering the health insurance premiums, but we're also lowering the amount of expenses that that health insurance fund is responsible for, which offsets that to an extent. And then that also offsets your savings, because now the general fund has to pick up those wellness expenses. So that's why the net savings would be about $105,000, because the general fund would have the increased cost of now taking on the wellness expenses from the general fund.
One question about, do we get a lot of requests for +1 health plans? Have we considered it versus having, you know, a couple pay the family plan when the family plan is really designed for, you know, more than 2 people?
Mm-hmm. Sure. So, and right now we don't, of course, offer the +1 plan. I guess I'll defer. I know that Lisa Yakush is on the is in the meeting as well. Lisa, can you, since you deal with HR and obviously you deal with the employees on these benefit issues, would you be able to answer that question as far as if we get a lot of requests for sort of employee +1?
Sure. Can you hear me okay?
Yes.
Okay. So we haven't gotten a lot of requests. Past years, especially when we first switched from a regular health plan to the high deductible health plan, there were a number of inquiries about the possibility of that at that point. And I kind of pointed out to people whose kids have grown up and moved on, gotten jobs, you know, got their own health insurance, what have you, to the fact that, you know, our plan supported their dependents for many, many years. And now, you know, we can, in theory, have fewer claims because our kids are grown, so we can kind of pay back the plan, if you will, number one. And number two, when we've looked at our high dollar claims, believe it or not, the majority of them do come from our own employees.
Okay.
So in the past, when we have looked at the idea of family of 2, you know, most often husband and wife, it just didn't make sense at the time because of what our claims were and what was driving them.
Okay, thank you.
Yeah, and then I guess the only other thing that I would add on that note is, so right now the family plan, the current program is equal to about 2.7 single plans as far as the rates. And again, we found that to be a little high, that it should really be more like 2.5 or 2.45. So with this reduction, what that's going to do is it's going to reduce that ratio from being the equivalent of 2.7 family plans or single plans to being the equivalent of 2.45. So it at least does, you know, now of course if you did employee +1, typically that would be 2. So even if we don't offer that, this change is at least helping to reduce that family plan rate and get it, you know, more in that direction, I guess. So, okay, and then we have our municipal services payment that actually increased, which is fantastic. So this is an aid payment from the state of Wisconsin for providing police and fire protection to state facilities. And of course, as you can imagine, the big state facility in Stevens Point is UWSP. And there are 2 parts to this formula. The first part is what we spend on police and fire, because that's the service that they're willing to pay for. And then the second part of that is the value of state-owned facilities in the municipality. And they have a formula where basically what they're trying to get at is, okay, how much value is this that you're protecting with your police and fire departments? And then also how much do you spend on those services? So we did have a new building constructed on campus, and that finally is flowing through to this municipal services payment. So that'd be the new chemistry and biology building. And that increased the value of those facilities. So that's why that payment is going up this year. Now, one thing that I do want to note, and I was very happy to finally see an increase on that, because over the years, we've seen this program pretty consistently decrease from over $800,000 back in 2007 to only just under $400,000 in 2017. So over time, this program has been cut quite a bit. Our share of this aid has gone down quite a bit. So certainly it's nice to see a little bit of a recovery there, just because obviously the university, you know, it's a tax exempt facility, so we don't get any property taxes on it. This probably doesn't cover the full cost of providing services to the university, but it at least helps to offset that impact a little bit. And then as far as other reductions, so I mentioned that for the City Hall courthouse maintenance line item, we did reduce that from $195,000 to $175,000. That line item has been as high as $196,000 in the past, but recent years have been lower pretty consistently. Over the last 3 years, the highest year that we had was a little over $170,000. So felt comfortable saying, okay, we can maybe back off on this line item a little bit and cut it a little bit closer to how it's actually been coming in. And then we also reduced the transfer to the liability and property reserve fund. And this fund, and I know we have a lot of funds, and you know, it seems like I'm always talking about this fund or that fund and how it works. The liability property reserve fund was set up when we went to higher deductible insurance for both our liability policy and also our property insurance. We have $25,000 deductibles on both of those lines of coverage, and we don't, you know, that's obviously a lot of money to come up with, or to have a department come up with out of their budget. So this fund is set up to cover these high deductibles if we do have a claim. And based on recent experience, we believe that $50,000 a year should be sufficient. That based on recent claims experience, $70,000 might be a bit rich, and you know, knock on wood, hopefully that doesn't turn the other way. But for now, we think that the $50,000 should be enough. And then the only other thing that I'll point out with these changes is, you know, if you have 1 year that's kind of difficult, you can maybe go through and sharpen your, you know, the pencil and find these little changes here and there where maybe we've got a little bit of extra cushion or a little bit of extra money. Of course, the concern is long term, you know, if you keep having budgets that are a little bit more difficult, you're eventually going to run out of things like this to reduce and to make adjustments. So that was everything for basically the sources of money this year, where the money is coming from. I guess I'll pause here because the next part is sort of the uses of that money, but I just wanted to see if anyone has any questions before I move on. Okay, doesn't sound like it. So then we'll move on to the uses of available funds. So as far as, you know, we've covered where that money has come from, now we're going to cover where it's going. So we do have our pay plan adjustment for 1.56% cost of living adjustment to the pay plan. Cost of that was a little bit over $107,000. We also did have quite a few employees get salary steps this year, just based on their seniority. So that did cost us $77,000. Now, typically the salary steps over time should not be costing us something year over year, because eventually you're going to have those positions or some positions turn over. They're going to be replaced with people that start out at the lower step, and that's going to help offset your cost. And for this year, basically, there wasn't enough turnover on the pay plan side for that to happen. So the total cost of everyone getting their step was $143,000. And then there was about $65,000 of savings due to turnover, due to people leaving and getting replaced with somebody at a lower step. So that did help offset it this year, but didn't quite cover the whole thing. And that's something that it's going to vary from year to year. You're going to have some years with a little bit more turnover where maybe, you're ending up with extra money because of the salary steps. And then you're going to have other years like this where you have to put a little bit of extra in, if you will, as your employee population is very stable and getting more senior and working through the steps on the pay plan. We also used $55,000 for the fire department union wage adjustments. Then we're planning on $45,000 in reduced room tax revenue. That's just the general fund portion. So that's just the portion that goes to the city. That does not include the portion that goes to the Tourism Commission. We also lost $45,000 with the elimination of the county recycling grant. And then we're also planning on $18,000 in reduced parking revenue. Due to COVID-19, of course, less people are out and about and parking and using the parking kiosks. And then finally, another impact is our general transportation aid did go down by a little bit over $78,000. And that results in reduced money for road maintenance and construction. So that doesn't impact what we have available in the rest of the operating budget, but it does impact what we have available for road maintenance and road construction. So kind of going through some of these revenue impacts that we've talked about. So start off with the COVID-19 related revenue impacts. The two biggest ones are room tax and parking that are really related to COVID-19. Room tax, we're looking at a reduction of 18% versus normal or versus the 2020 budget. And parking, we're looking at a reduction of about 14%. So overall, we are anticipating that these revenues will still be less than normal, but we also are expecting that they'll be better than 2020. Certainly, if we wanted to be really conservative about this or really err to the side of caution, you could reduce them even more and I think justify it. But, I think we're all obviously looking to, okay, how's 2021 going to develop in 2022 and what is this going to look like? So didn't want to overcorrect either. And then we also have the elimination of the county recycling grant. So the existing arrangement is that the county accepts our recyclables for free, and they also pass on some of their state recycling grant revenue to municipalities. And now, of course, there is a cost to the county solid waste department for processing all these recyclables and sorting and everything else that goes into that. And they do rely on the sale of recyclable materials to help cover those expenses. Unfortunately, the cost as far as what you can sell these recyclable materials for that has gone down. So they're getting less revenue from that source. So for 2021, the county can no longer pass on a portion of the recycling grant revenues. They need all of that to support their program and the operation of that program to make up for the lost revenue in terms of selling recyclable materials. But for 2021, they will still take our recyclables for free. And then one thing that we've been sort of warned about as far as that could be a possibility is in 2022, the county might start charging a fee for accepting recyclable materials as well, just depending on how things develop. So that's something that if that happens, we might have some kind of a fee to pay as well for recyclables, similar to what we have right now for refuse or garbage. We do pay a fee per ton, so you might be looking at something like that for recyclables in the future, depending on how that develops. And then also the reduction in general transportation aid, want to talk about that a little bit. So we use our transportation aid for two different purposes. One is the operating costs related to roads, and then we also use it for road construction expenses. And what we do is we use about $1.4 million of it for operations, for the cost of plowing the streets, salting the streets, those eligible road costs that we have every year. And then any amount above 1.4 million, we've been putting into road construction and road maintenance. So the changes, if there are changes from year to year, that affects how much we have available for road construction expenses. So because of that, what we're proposing to do, and I know I mentioned this last week during the adoption of the capital budget, that okay, there's this one piece here that became an issue that we want to try and do something about. Basically, we're proposing to increase the capital budget by $50,000 to partially offset this reduction. And the funding of that would come from increased fund balance application to capital. So basically increased use of savings to fund capital projects so that we can backfill some of this lost revenue. So, and then this graph shows how general transportation aid has changed over the years. You can see actually in recent years, it has done pretty well. This has been one of our better performing state aid programs, which had been really nice. And as this went up, we were able to put those extra amounts into road construction to help deal with some of our infrastructure activities, which we all know are very significant. And unfortunately now this year, it came back down a little bit. So overall, it's kind of ironic. I guess maybe things are coming back into balance a little bit, that I think the municipal services payment that we get for providing services to state facilities has probably been our worst performing state aid program, and we finally saw an increase in that this year. And then the general transportation aid, the one that has done pretty well, had a reduction. So they're kind of going back to maybe the past a little bit. And then this graph shows the use of fund balance for capital from 2013 to 2021. So for 2020, we used $974,000 in fund balance for capital. We're proposing to increase that by $104,000 to $1,078,000. So, and you can see since 2018, we have been able to bump that up a little bit every year as far as the amount of savings that we put into capital. And that is based on the financial performance that we've had in recent years. And certainly one thing that I've told the department heads, over and over again is that, well, if you don't spend your entire budget, and some of that comes back to the city and goes back into fund balance, we aren't just going to hide that money in a dark corner. That does have a positive impact on the amount of money that we can put into capital. And as we've had strong budget performance, that has allowed us to increase that use of fund balance for capital. So, and I wanted to cover this slide just because we are proposing to bump it up a little bit more to backfill those road construction expenses. Okay, so then looking forward to 2022 and beyond, I think it's sometimes nice to always kind of take a peek at, you know, what do we anticipate in the future? Of course, these are just estimates at this point, but it's nice to sort of have things on your radar screen as far as future effects that we could see. So for the 2022 budget, based on some construction projects that are currently happening, we do anticipate that new construction will be a little better than it was for the 2021 budget, but still probably below 2% in terms of net new construction. So rather than 25 million in net new construction, we're looking at maybe 35 to 40 million. So which sounds like a lot, but unfortunately doesn't work out to a huge percentage, works out to a percentage of more like 1.5% or 1.75. And then also we will have a decrease in revenue due to interest income unless something changes with interest rates. I know we talked about this a little bit before, especially when we talked about the financial impacts due to COVID-19. And we do have our deposits primarily in a 5-year deposit ladder, which locks in our interest rates for a longer period of time and really helps absorb that shock, which is a good thing because I know there are a number of municipalities that are looking at reductions of several $100,000 in interest revenue for 2021 and trying to come up with this in their budget. So the deposit ladder does help with that, but what it also means is that, okay, you're going to take a little hit every year as those deposits mature, and then they get renewed at lower interest rates. So that's why. Go ahead. Yep.
Oh, yep. Thank you. So, and I love the laddered investment strategy. That's the best thing to do. The loss of expected, a decrease in revenue interest income. Do we balance that out then against savings with some really good interest rates for our capital projects? So I think there probably is a balance there, or I'm assuming there is. Is that the case?
Well, so we definitely do save on interest, and certainly the bonds that we're going to be issuing right now, we're definitely going to save money in interest. One thing to remember is that, we still have levy limits. So if the amount of interest that we're paying on our debt goes down, that's great, but that's outside of the levy. That's true. The revenue that we get from our interest income, that revenue is going to offset expenses that are basically inside the levy, their operating expenses. So it does help. It does help us, keep the levy down. But as far as avoiding an operational impact, unfortunately, it doesn't get us out of the loss of revenue in the operating budget. Okay.
That makes sense. It could also, yeah, there's going to be a balance there, but I forgot about the capital being outside the levy. So thank you for that.
Sure. And then we also expect that expenses will go up for elections in 2022 just because we'll have a gubernatorial election and we'll have 4 elections rather than 2. So that's something that election expenses go up and down every year because you're always transitioning from having 4 elections a year to 2 to back to 4. And then looking a little bit farther, 2023, based on what we have going on right now, we actually anticipate that net new construction should be better than both 2021 and 2022. But part of that will depend the projects that are happening right now, how much of that is completed before December 31st? Because whatever is completed before December 31st will be part of our 2022 net new construction number, and whatever is completed after the new year, that will be part of our 2023 net new construction number. So that's why usually around the end of the year, I'm kind of taking notice of the various construction projects that are going on and how much has been done at that point to sort of get an idea of how much is going to go into which budget. And in general, when we see projects go over 2 years, it's fairly common to see a lot of that value added in the second year, just based on the process of construction. And then we're also looking at a decrease in revenue from interest income, again, of $45,000. The reason why it's higher is because the deposits that mature in 2023 are paying a higher interest rate than what we have maturing in 2022. And then we'll also have a decrease in expenses for elections. And then the final slides are related to the tax levy. And I know we're not going to vote on that tonight, but at least wanted to introduce where we are so you know. I know that we had talked about an increase of about 2.5% for 2021, which would have been a rate of about $10.20. And I know that in my memo that I included in the packet on Thursday, I indicated that, you know, this was an estimate, but that, you know, we're looking at around $10.20. We did have something fortunate happen on Friday afternoon. We got our equated manufacturing values from the state. We're able to update our calculations. And what we're actually looking at now is $10.16 per thousand. That's an increase of 2.1%. So hopefully, you know, we tried to keep it reasonable this year. I know that I heard from another number of people that that was important due to everything going on with the economy, due to the increase in taxes in recent years due to the school referendums, that we were feeling that people really, you know, needed something that was reasonable, and hopefully 2.1%. I know different people might have differing opinions, but hopefully that's something that we can feel good about, relatively speaking. And then this just states what the proposed levy would be that we anticipate taking up in November. And again, looking at a rate of $10.16, total levy of $17,251,000. So with that, that is the end of my presentation, and I will take any questions or comments or anything that anybody has.
I guess I would go to the Finance Committee members first, if there's any questions from for Corey from any of the Finance Committee members. From any of the other alders. From members of the public. And members of the public, please know there'll be a public hearing on this in November. So members of the public, you will have another chance to weigh in, as will the alders, as we go through this process in November.
I think the mayor has a few comments.
Oh, I didn't see him there. Thank you for pointing that out. Go ahead.
Thank you. First of all, I want to commend Corey and his staff and all of the department heads for their hard work on the capital budget. The operational budget and the capital budget. But I wanted to point out, because of the deafening silence when you asked for questions, it doesn't mean there weren't questions. And I want to thank all of the alders who had submitted their questions prior to the meeting. We were able to get those answered, and that usually makes for a smoother meeting. If there's still concerns, of course, by all means, bring them up. But I know that myself and other staff members had answered multiple questions from some of the alders. So I appreciate your input and feedback on the budget. Just wanted
Thank
to say.
you. Thanks. All right. And we are not going to entertain item 3. Therefore, our agenda is exhausted, and we are adjourned at 6:51.
Videos of these meetings are available for viewing on the city's website, stevenspoint.com/videos.